I've only done cigars once, and it was in this really, really high upscale cigar lounge in Vegas where we got like a private room and they came in and they taught us how to smoke cigars, and it was actually pretty cool.
Well, Jay, I knew you weren't a cigar smoker, but by the first words where you're like, the only time I've done cigars, like you're doing drugs, like
I thought the same thing.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 91 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and this is the last week we're back together again. Who we missing next week? Someone's gone?
Dude, I'm going to be in the Florida sun next week.
Mauricio's gone, but we got AJ and Jay back, so the important ones, starting with Jay. How's it going, man?
Good. I'm going to be in the Florida sun next week too, but I'm not missing the show.
Man, what an excuse, Mauricio.
Spotty Wi-Fi in Florida, apparently. What are you drinking, Jay?
This week I decided to go with a big glass of the clear rum. Actually, this is just a glass of water and an unopened bottle of the clear rum. I'm being good tonight. I'm going to the gym after this episode. So
Are you going to open it or not?
I'm not going to open it. I'm going to the gym after this episode. I'm not going to drink before I go to the gym. What? So
Jesus.
You got me sober tonight. Be happy.
What?
Actually, it's much more fun working out with a little bit of a drink in you. Actually,
I have to drive there. So
I've had quite a few times where I went out the night before till wee hours in the morning and had a 6 a.m. workout, and I was not hungover. I'll put it that way.
If I didn't have to drive to the gym, I might actually do that. But
AJ, how's it going, man?
Going good. Got my red Solo with Diet Coke. Ready to go.
No cigarettes or cigars. We already went through that. No tobacco for the Mormons.
Right.
It's a sad day. No fun. All the fun stuff.
No fun for you.
No fun for you. Mauricio, what's up, buddy?
Doing good, man. Dropped 10 pounds in March on the fitness challenge, but only a small percentage of that is fat.
How much have you regained in April?
Yeah, in April it's already we're already back 5 pounds, and then after drinking my little Macallan's here, so I'm back to Macallan's. I'm trying to do low cal. I think this is low cal, isn't it? Compared to wine.
You know, if you're looking for low cal, low sugar, no carbs.
Yeah, but I want to enjoy myself, so that's out of the question.
Yeah, that's not what I do. I just drink to get there.
What are you drinking, Kyle?
Which is why I'm drinking. I'm same stuff, man. Same stuff. I'm gonna go. Oh, I gotta go around my mic stand. A little clear water. No carbs, no sugar. 99 calories. Gets me there. Gets me going good.
You go. By the way, you guys have been dropping some pounds too. You can brag. Yeah,
I'm down 7.
Yeah,
7 pounds, which is significant for me.
But it's all water and it's all non-fat. That's the problem. We need more fat loss, not non-fat loss.
I already had a pretty good baseline of muscle, so I don't know. Like, I don't think I could gain much muscle, but
because you're like, what are you, Schwarzenegger over there? You think you're too good for everyone? You just can't put any more muscle on? What are you talking about?
No, I've just been working out 4 or 5 days a week for the last 12 years of my life. So
yeah, but you know what they say? The definition of insanity is doing the same thing again, expecting different results. You should mix it up a little bit.
I don't really want to be any bigger. Do you think those really big guys, like, you want me to walk around like with like my arms hanging out to the sides? Like, that's not me.
I got a news flash for you, Kyle. You're not big, dude. You're in good shape, but you're not big. You can get bigger.
I don't want to be big though. That's the thing.
All right. You want to be? Oh, that's right. You want to be Brad Pitt. You want to be Brad Pitt on in Fight Club.
I'm bigger than him. He was 165 pounds there, which I did look up. I looked up his body fat and his specs because that is the ideal body on a man.
It is. Absolutely.
I am big enough that I just got to stay big enough that I could always beat up my daughter's suitors. That's kind of where I'm at. And my daughter's 10, so I feel like I'm pretty good. All right. You want to get into this?
Let's go.
I feel like this is the worst timed episode because we're recording on Tuesday.
Ugh.
The tariff D-Day is tomorrow on Wednesday, and then we're releasing Thursday. So we don't know what's going to happen tomorrow with the tariffs, but then we're going to be releasing after it's already happened. So like a bunch of going to hit the fan probably, and we're going to have no idea. So, but we're going to try and give it an economic update anyway. And regardless of the tariff income, we still have some inflation numbers, job numbers, stuff like that. So,
and by the way, before you do I don't know who you're going to introduce first. I have no idea what's going on the show, but don't forget that this is the week. This is the week that Jay Scott has predicted the end of the world. I think Friday, right? Friday, April 4th is when the world ends. We have a huge economic collapse, which is another reason I'm drinking. I've got my stiff drink because the world's going to end this week.
yeah. So Jay, we'll lead into that. And does Tariff D-Day, is that going to help or hurt your prediction?
So it's weird. I was expecting that Monday and Tuesday this week we were going to see some crazy roller coaster stock market, like some big stock market losses leading up to tomorrow. And again, if you're listening to this on Thursday, it was yesterday's implementation of tariffs, because I mean, it seems to keep getting worse. I mean, it was reciprocal tariffs. Now it might be 20 or 25% tariffs against every country in the world. I don't even really know. I'll be honest. I haven't been able to keep up, and I'm not convinced that whatever was said today is actually going to happen tomorrow. So I can't quite figure out what the whole tariff plan is. But before we get into tariffs, I want to talk about something. I'm starting to hear a word. I'm starting to hear this word.
Stagflation?
Yeah, that's the one. I don't like using the word because
you hate that word. You were on record saying that you didn't want to use the word because it gets overused, and
I hate the word. I hate the word, and I'm not going to say we're anywhere near it. I'm not going to say I'm predicting it because it's rare and I think it's unlikely, but a lot of media outlets and other people are using this word stagflation. And for those who are uninitiated and don't know what stagflation means, the stag basically means a stagnant economy or recession. The flation part means inflation. And so stagflation is that situation where you have at the same time a softening economy or a recession along with inflation, because normally those two don't go together. You have inflation, the Fed raises interest rates, that crushes the economy, and inflation goes away. But in some rare cases, you get both inflation and a bad economy. We saw it in the 70s a lot, where we saw several recessions, and we also saw prices going through the roof. And it's a really bad thing because, again, what the Fed does to quash inflation is the opposite of what it does to solve a recession, and vice versa. And so the Fed basically has to choose between the two if we get in that situation. And again, we're not close to stagflation right now, but we're starting to see a little bit of grumblings with respect to both recession and inflation. Let's start with inflation. So PCE, so the producer, what's PCE stand for? I don't even know what it stands for. PCE, the Personal Consumption Index. Thank you. And I'm thanking myself for thinking of it. Sorry, I'm not prepared today.
You spell index with E?
So PCE came out last week. That's the Fed's preferred gauge of inflation. Came out a little higher than we expected. It was the hottest month we've seen in a year, up about 0.4%. And the core number, if you exclude energy and the other thing.
You okay, buddy? Maybe you should have a drink.
Why don't you open the non-tasting, non-colored,
I've had a long, stressful day trying to get a deal done, and so sorry if I'm a little out of it today. So
that
anyway,
is not done. So.
Yeah, it's not done. Core inflation was up a little bit. And long story short, we're seeing a little bit of inflation. It's probably from tariffs, if not from tariffs, from the threat or the fear of tariffs. A lot of people importing a lot of stuff now, thinking that that tariffs are going to get worse. And so long story short, we're seeing potentially a little bit of inflation. At the same time, we're seeing some softening in the economy, or at least some rumblings of softening in the economy. There's talk of GDP being really bad this quarter. Again, we still have a month left. Well, we don't have a month left in the quarter. The quarter's over, Q1, but we have a month left of getting data from Q1 before we know what happened in Q1 in terms of GDP.
But when, in terms of GDP, we're not talking about rumblings, or we're talking about the Fed, the Atlanta Fed's own estimates are showing at this point in time, like almost a negative. We're at 3, right? Like a 2.8 or 3.
Yeah.
That's
So,
the
so
Fed.
the,
That's not like the New York Times predictions. This is the Fed, Atlanta Fed, right?
yeah, this is the Atlanta Fed. And the Atlanta Fed, I mean, what they do is they have this model called GDP Now, where they take all the data as it's released. And this is the same data that you guys and I can look at. They don't have any special data that we don't see, but they plug all this data into a model they have that calculates GDP, which is not a complicated calculation, and it spits out where they think GDP is for the first quarter based on the data that's been released so far. And so far, we have January and February data. Over this month, we'll get March data, and they're saying somewhere around negative 2.8%.
But it also doesn't predict forward, right? Like it just is current real time. So they self-admit that this is not like a prediction of where we're going to land.
But they also have a history. They have a history of over. What's the right word? They sort of start really high and then they always end lower, right? So it's like it's not like they're conservative in their numbers. Like they're usually the other direction.
Yeah, but it doesn't mean they're right. AJ and I had talked about this. I don't know if it was on the air or off the air, but their one big miss was a really bad quarter that we had, or they predicted a really bad quarter back during COVID, and they were off by a lot. And so don't take this as gospel. It doesn't mean that Q1 GDP is going to be negative 3%, but if it is, that's a huge contraction. That would be the largest quarter over quarter contraction that we've ever seen in our economy. Now, CNBC does this analysts and economists survey. They're coming in somewhere around 0.3%, just barely positive growth. Blue chip. So there's this blue chip survey that looks at some big companies that run some models, and they're looking at like negative 1% or negative 0.5%, something like that. So we don't know where GDP is going to be.
I'm willing to put some big bucks behind a negative number.
I think it's very likely we see a negative number. I don't think we're going to see negative 3%, just because that number feels so big to me that it just seems crazy. I don't have any.
Yeah, but even negative, I would actually put some serious bucks on a negative over 1, like 1 to 2%. I would put some big bucks behind that.
Now, here's something to keep in mind. I think this is a really important discussion because we hear this term GDP and people don't dig in. It's important to realize that a big component, not the biggest, but a big component of GDP is imports and exports. And when you import something, basically you're paying somebody else for the work they've done. That's a subtraction from GDP. When you export something, that's work that was done, production in the country, that adds to GDP. And so when you have large negative trade balances in a month or a quarter, basically you import a whole lot more than you export, that's going to reduce GDP. And what we saw in Q1 was, again, because of tariffs, because businesses were absolutely terrified that prices were going to go up because of tariffs, we saw a huge trade imbalance in January, largest we've ever seen in a month, meaning we imported a whole lot more in January than we exported. And so that's going to have a big negative impact on GDP. Is it going to be enough to push it down to -3? No, other things would have to go wrong for that to happen. But let's keep in mind that that is an impact on GDP.
And it's a timing impact. And that's one of the problems with it. It's not like, and that's why I think a lot of people are going like, wait, what? Because we have like the lowest unemployment. You got like, I mean, the stock market, even though it's gotten hammered, is still like way up and jobs are up. So it's like housing's up, everybody's like assets are up, wealth's up. And so but because that's really like important what Jay's saying. You could come back and be like -3. If it was, it would be largely due to that. And people would be going, I don't understand. Like how, like, because
people are doing weird too right now. Like I know some people who are fast tracking things because they want to get ahead of the tariffs. And I know other people are like, oh, I'm going to wait because these tariffs, they're just like a negotiation tactic and everything's crazy right now, but it's going to die down in, 3 or 4 months. And so like there's both sides of it. People are acting, one side's going to be irrational. The other side's not going to be, but acting as they otherwise wouldn't. And I feel like there's weird stuff happens where you're like, oh my God, this is a big deal. And then it just ends up not being a big deal.
Yeah, well, we have seen spending decrease. I mean, we talked last week or the week before about consumer and business sentiment. People are thinking things are getting bad, and apparently it's impacting how people are spending. In March, or was it March? No, it was February. We got the February consumer spending numbers, and we saw 0.1% increase in inflation-adjusted spending, which is really low. We like to see more spending, not stagnant spending. And so that's an indication that people are slowing down their spending. On the good side, maybe we're seeing savings go up. So personal savings rate in February went up a lot. It was at 5% annualized, which is a huge number, which is great for individuals, but it tends to be bad for the economy. When people save their money, they don't spend their money, then we don't have money moving through the economy. So people saving money.
Why are they saving their money?
Probably for the same reason they're not spending it. They're concerned about a downturn. And so, but it's good that they're saving it, because it means more money in their bank account. Obviously it's bad for the economy.
I can't breeze past that comment where he asks, why are people spending money? And your response is probably for the same reason they're not spending it. That was great.
Well, I mean, if we saw huge wage growth, we could see spending increases and savings increases, but that's not.
It's just when you said that, like I'm looking at a couple, like I pay attention to things. I'm sure everybody else pays attention to it, but like I'm paying attention to like gold, for example, right? Like gold is at an all-time now, pretty much all-time high, now past 3,100, on its way to 3,200. I mean, it's already way past the 2,000 mark, blew by 3,000. What does that mean? People are concerned. They're going to conservative stuff. You look at the 10-year note, it continues to drop. That means people are buying treasuries.
Don't jinx it, Mauricio.
The what?
Don't jinx it.
I'm just saying, like, people are concerned, and so they're now going into more what typically are conservative investments when people are concerned about the economy. So they're going into treasuries, which they perceive as safe, and so they're going all to safe assets. Individuals, they're saving more. Their personal savings rate is going up because they're concerned. They want to hoard a little cash because they're expecting the what to hit the fan, and whether it happens because it was going to happen anyway, or it becomes a self-fulfilling prophecy, which is an interesting concept. We don't know, but all data starts to implement that. Maybe Jay's, I hate to admit this, but maybe Jay's onto something here.
We get 3 days though. I don't know about 3 days from now.
I think it's tomorrow. Tomorrow isn't the ADP numbers coming out on Wednesday?
Yeah, ADP. So Friday is a big employment day. We get to see the March employment report, where my original thesis 6 weeks ago, and keep in mind, I made this prediction before the stock market started to drop. And so you could argue that like the last 6 weeks has been, I've kind of been on something.
And I remember too, like over the last year, like especially election year, like the jobs reports, jobs were being fueled by government and healthcare jobs being created, right? And that's obviously government jobs are not being created right now. They're going the opposite way.
And this is my ignorance here, is the ADP report, do they include the government jobs or not include the government jobs? Okay, because my thesis was, just because I wanted to do something different from Jay, obviously, he was predicting this Friday because jobs report comes out, that was going to be a big jolt. My thinking was 2 days before the jobs result, we always get the ADP, which is kind of like a little bit of a preview of potentially the Friday report. So if ADP comes down surprisingly low, we could have this issue happen on. So my call was Wednesday, not Friday, if something was going to happen, and that's going to be yesterday as of the release of this podcast. So we'll see how that went.
Well, here's the interesting thing. When I made that prediction, we were seeing lots and lots and lots of federal job cuts. And it looked like we were going to see a whole lot more. And then there were a couple of court cases where there were some injunctions where a couple of judges said, hey, you can't just fire all of these people. You have to give them their jobs back and go through the right mechanisms. And so there were thousands of I was about to use the term transitory, probationary employees that were given their jobs back, even though a lot of them are basically.
Jay, save your excuses for why you were wrong until next week when you're actually.
I'm not saying I'm wrong.
February was horrific, though. February's job loss was huge. How many? Because I mean, it was like all government employees, but wasn't February's? I think February was a.
I have to look. I don't remember February being that.
150,000 job loss, the largest since, because in August of last year, there was roughly 50,000. And in February, it was 122,000 job loss, which is almost all government employees. but I mean, huge. That's the biggest you've seen in how long? I mean, years.
Unemployment rate was still at 4.1% as of February. So it'll be interesting to see what happens on Friday. I still think we're going to see a pretty bad jobs report, and I think that might shake up the market. But I think what somebody said earlier about tariffs tomorrow, that could be a bigger story. And so, again, I haven't even been following exactly what's going on. I've heard rumors that
you're like our economic expert. How are you not following the stuff?
Because I don't have the time. I mean, literally, it feels like it changes by the hour, and we're not getting. And I'm not knocking the president for this. He doesn't owe us anything in terms of what he decides to do, but I mean, he put out an April Fool's tweet today, or Truth Social, whatever you call a Truth Social. Today.
No, dude, just call it a True Social. That's what it's called.
A Truth Social. Okay, he put out a Truth Social today that said, "Hey, no tariffs," like an April Fool's joke. But maybe it's not an April Fool's joke. Who knows?
Well, no, that's why he put the deadline April 2nd, because he didn't want people to get confused about the April Fools. If you want to track it, though,
there's no doubt that the back and like nobody knows what's going on. Like I think we all think that he's doing this sometimes as a negotiating ploy. I mean, it makes no sense that he's suddenly countering with tariffs like worldwide and for everyone. That makes no sense. And then we're not sure if he's going to go through with it, if he's going to like pare it back. And so that uncertainty is definitely rattled.
Well, it's interesting this time too, because previously it was only with like a few countries, and
now it's suddenly like freaking Bangladesh gets to get screwed with their automaking.
Like there's no way he can go and negotiate with all of these people all at once, right? Like it was one thing if it was just Canada, Mexico, and China, like he could just crack that out in a day if he really wanted to, just give them calls and figure out a way to stay it. But he can't call every country in the world.
He needs to start basketing them by continent. Like if he could just do us all a favor and be like, you know what? I think Africa, we're just going to do tariffs that, not even countries anymore. There's too many of them. Just continents. Asia, here you go. Europe, here you go. It's just easier that way.
Yeah, but he's a business guy. I bet you he has like regional managers. So he's got like one guy in charge of Asia, one guy in charge of Europe, and then those guys below them have individual countries, like one person responsible for each country. He's got a whole business set up, I guarantee you.
Okay, can I tell you guys something like funny to think about, or I don't know if it's funny
how.
No, we got to move on.
No. This
when you say funny though, do you mean like Jay Scott funny, or are we talking like more AJ Osborne?
Let's hear it, Jay.
Funny how? Am I funny like
the
a
Costco
clown?
story?
Am I funny like a clown?
Like I'm a clown? Like I'm here to amuse you? Like what?
Do I amuse you?
Tell me a funny joke.
Do I amuse you? So keep in mind, the way tariffs work is that the Customs and Border Patrol, when a product comes in, they need to figure out what the tariff is on that product and then charge the quote unquote importer of record. To figure out like what the tariff is on a product, they have this table called, I think, the harmonized tariff list or something, the harmonized system. And it's just a list of basically every product in the world and the tariff associated with it. There's a group of people somewhere that literally every time Trump says, I want to change tariffs, I want to add a tariff on this, or I want to subtract it on this, or cut it, there's somebody that has to go into this table and change it.
Just all these, like, you got to just see them sweating as they watch the news in the morning, like, oh no.
Now here's where it gets funny. Can you imagine Elon Musk going into that department and saying, I don't know what any of these people do, I'm firing them all.
You're out.
Is there like an appeals process? Do you get to the customs agents like, dude, my tax is 13%? The guy's like, no, it's 25. And like, no, it's 13. No, it changed yesterday. Like, is there like a dispute resolution?
You sure read it, man. It's 13. Let it through. It was on the news yesterday.
It's like gambling. There's like a futures market. I'm going to wait till tomorrow to pick up this product in hopes that tomorrow it's cheaper. Did
you see that the tariff department actually posted a photo from their department of what their department looks like right now? And this is what it looks like.
Oh, that's awesome.
Dude, you gotta describe that for our podcast.
It's the meme from Always Sunny where he's got all the things on the wall, and he's got all the red dots and the pieces of string all connected to each other and stuff. But I made this joke before. Like, can you just imagine if you worked in that department, just going to work every day? Like, just like not knowing, and like I assume like have they tripled their staff? Like, I assume they probably just have the same amount of staff and they're trying to deal with it. I would quit.
Honestly, I bet you they're just like, just wait, just next day, like wait.
But the stuff comes in, they got to do something, right? They're just going to let it pile up on their desk and just sit there, like, and then because that does happen, a week later they could just shove it off their desk. It's no longer an issue. But we'll see.
Yeah, we don't know what's going to happen, and
we'll see. We might. We might look like idiots on Thursday because nothing happened, or it might be.
So should we take a bet? What we think tomorrow? If nobody knows, so everybody listening to this, you'll know. So if we all say what we think is going to happen tomorrow, do you think it's going to be like 20%? Do you think we're actually, or do you think it's going to be a nothing burger where he's like,
It's definitely going to be something different than just everything gets to 25, like the normal, like the whatever the course is right now. It's not going to be that. I'm going to go on record. It's not going to be 25% for everyone. There's going to be some announcement about some, either a pause for some, or there's going to be something going on. That's my call.
For sure. He can't walk back entirely. He has to have some sort of.
Hey, I talked to the president of Mexico, or I talked to the president of this, and we agreed, and they're working on this, and we're gonna whatever. Like that's
so.
What
I'm the guy that is always saying he's not going to do it. He's going to back off. He's gonna change his mind or negotiate or find an excuse not to do it. I'm going the other way this time. I think tomorrow he's going to do a lot more than anybody expects.
I think so too.
And
hey,
so
as
you're
long as
if you're listening to this,
he's going to do something affirmative. Like he's going to do something affirmative tomorrow, or just go through with the current plan.
So I don't know what the current plan is, but
well, so you can if you just search for tariff tracker. Reed Smith has a pretty good. They update it daily.
I would love to see that chart. Ding 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 ding.
Yeah, it gives a good summary. It gives the country, the status. It gives what the rate is. It gives if there's been any countermeasures. I could throw it up real quick.
Where there's a Trump is this the Trump 2.0 traffic?
Exactly, the Trump 2.0 tariff tracker, because they tracked it last time on the tariffs. But
there it is. It's TBD, to be determined.
Yeah, so you could actually go and you could scroll down and it shows all the different each country how they're affected. So I always scroll down to Canada, and then
Chile. Do they have some copper imports tariffs?
This is how I do it. I hit Control F and then I type in lumber. Because that's all I really care about. And if there have been any changes to the lumber. So anyway, if you want to go check that out. Because I'm sure they're all hands on deck for tomorrow.
There's nothing. Chile is not on there.
Must not be messing with Chile. Okay, I gotta say, I've never, because I'm an American, so I've never once ever thought about Canadian politics, products, or even the country. And so now I've been thinking about it, and it is so funny because I started watching things, and all of a sudden my feeds start getting hit with Canadian stuff, and I'm watching all of these memes of the politicians and how they're getting up there and they're talking about all this stuff. I've never watched another country, right? Get real big mad at us, and not because they don't, because I'm an American, so we just don't care what other countries do. And it is so funny. I'm so addicted because I'm oh, it's just hilarious listening to him. And then there's all these things.
AJ, it's even funnier for me as a Canadian or former Canadian. I'm still Canadian, but as far as America is concerned, I had to denounce my citizenship. But because I've grown up watching how politicians act, I've grown up watching how they talk and how reserved they are, and how when they get all heated, it's not really heated, But
yeah,
now it is full blown. You would think that we're at war the way
oh
they're
my
talking
goodness.
in Canada, and they are so mad. My parents, who I know listen to, shout out to them. They listen to every single podcast. They don't even. They're scared to come visit us in the U.S. because of the shame that Canada has put on anybody coming down to the U.S. Get deported. Anyway, we're getting off topic, but it'll be interesting. AJ, do you think it's a nothing burger? Jay thinks it's going to be significant.
No, I think he's going to roll out I think he's going to hit some countries hard. I think there will be a bunch of carve outs.
I mean, this is the MO of Elon and Trump in this time around has kind of just been like, hey, let's break and then figure out what needs to be fixed on the back end. So I feel like that's what he's going to do.
They are trying to redesign. They're saying, listen, we're done. We don't think this has been fair. We don't think it's equitable. And they're just like, we're doing it. We don't care. We're reshuffling the cards. And I think that's not something that is just talk.
I just thought of a great analogy. You have you ever done this where like you're at a house and the electric panel isn't like labeled, and so you got to figure out how to turn off this light over here, and so you got to like hit the switch, and then you got to see like what
somebody in the house yells, kitchen lights went off.
Yeah, I feel like that's what they're doing. They're just doing, okay, I know this shuts off a bunch of stuff. Some of it might be important, but we're not really sure yet. Let's turn off this breaker and see what it shuts off. And I feel like that's just what they're going to do. And then they're going to be like, okay,
we'll try to turn it back on.
Yeah,
if
we'll
not,
rewire it. Like, yeah, that shouldn't be wired there.
Yeah.
We'll rewire it. I feel like that's what they're
And
doing.
hopefully it's not the life support machine in the other room.
Hopefully it's not the refrigerator. All right, let's give Mauricio some love here, because we talked back in episode 79 about Trump's SEC chair nominee, Paul Atkins. Well, on Thursday, the Senate Banking Committee convened to consider his nomination. And while most people consider anything SEC related to be about as boring as a J. Scott monologue, I know Mauricio dominates that. So, Mauricio, how'd that event go?
First of all, nobody gives a rat's ass about the SEC commissioner or anything. Do we really want to do this update? Yes, Paul Atkins, SEC commissioner, last week got his confirmation hearing. It was really I wouldn't say a dud, but really a non-event. A little bit of Elizabeth Warren, getting on her high horse about his ties to the crypto industry. He holds about $6 million of crypto, as I read. But the guy's worth like $325 million. So that's like 2% of his holding. But so really nothing fancy on the hearing itself. So it's predicted that it's going to be an easy confirmation for him. So he is going to be the next SEC commissioner. And what's cool for us capital raisers, syndicators, fund managers, if you're in that world, that's just good news for you, because he is definitely he's pro making it easier for you to go raise money. I mean, we've already seen actually we didn't talk about this, I think, in the last episode, but we have a new rule that just came out that made it super easy, really easy for you to do some verification in certain instances when you're raising money. So that came out a couple of weeks ago. But all of the rules and regulations that are coming out of the SEC today, which let's not kid ourselves. He's been talking to and has a direct line of communication with the current SEC commissioners, and his policies are being enacted. All of his policies right now are to be more expansive and less regulated. And he specifically has said he wants the SEC to be less restrictive. He wants it to be like, he thinks it's been politicized in the last few years, and that that's been detrimental to the little guy. And he wants to focus more on sort of what the SEC really is meant to be. So we're expecting much less regulatory schemes when you're raising money. And the ones that I'm excited about the most, which I'm going to go on record today, which is when this comes out April 3rd, I think the two biggest things that are going to happen in the next, before this administration is over, you're going to see two major things that are going to affect everybody on this show. Number one, the ability to become an accredited investor is going to be 10x easier. So right now there's some really high net worth and income requirements.
And he called out, if you watch it, he did call out accredited investors, and he didn't say about making it easier, but he said basically accredited investors, he implied that they should have less restrictions and that they have the means. And
yeah, I have no doubt that I would say my call has been by the end of this year, but certainly by the end of the administration, you're going to see a change in the, what's the right word? Easiness, if that's the right word, to become an accredited investor. Meaning if you're not accredited right now, you're going to be able to go take a test and show your abilities to understand all the securities laws and become an accredited via a test as opposed to income or net worth. That's coming. I have no doubt. I will stake my entire reputation on it. And then the other thing I think is going to come down, which he kind of alluded to in the hearings, is this ability to pay people to help you raise money. Right now, you need a license to do that, a broker-dealer license. I think before the end of this administration, you're going to be able to refer people to syndicators, refer investors, and be able to get compensated for that referral, get a transaction base, like a commission. Like, hey, if I have somebody in my network that invests $500,000 in AJ Osborne's deal, I'm going to be able to say, AJ, you got to give me a little sweetness, like give me, 3%, 5%, 50 grand, whatever.
Who was that?
Guy invests in your deal.
Who was that who did that? Can I get his name?
Yeah, exactly. Right. So there's going to be that ability, which actually is going to help a lot. Think of it this way. There are all these people in the industries. Like, I'll give you a great example. CPAs are a great example. Like there's a lot of CPAs out here that are like sort of do all these wealth analogies, and they say, hey, look, in order to reduce your taxes, you need to go buy real estate. You need to invest in oil and gas. You need to go do this. You need to go do that. And so they want to refer people out to the folks that have real estate projects, that have oil and gas projects, but they can't get compensated for that referral today. Fast forward before the next 3 years, you're going to be able to have CPAs refer their clients to you guys who are raising money and be able to charge a percentage. So I think the ability to raise money is going to become easier over the next couple of years, thanks to the new SEC Commissioner, Paul Atkins.
Does that start to put broker dealers out of business?
No, because broker dealers don't get out of bed unless you're raising, massive amounts of money.
Well, because it's so hard to get that license, right? Like, is there going to be?
It's impossible. Yeah, like the license itself makes no sense. Yeah. So
is it going to be the Wild West, or is it going to be like, hey, like you need to have some sort of because the problem that we get into now is the Instagram person who, like, we just saw it. Actually, shout out Free Hawk Tua. SEC just came out and said they're not going to charge her in the crypto thing. But that's a good example of, like, you have people, she didn't end up being the person raising money. She just endorsed it. But you do have people, Instagram people, who don't really have any knowledge of the inner workings of the deal, going on these social media platforms and saying, hey, this is a great deal. You should come invest in this. This is a great deal. There's a huge difference between that and somebody who knows, is working in on the deal, who knows, is sophisticated enough to know this is a good deal. But if they want to raise for something that's not them putting it together, they would have to go and get this broker license.
Yeah, there's already a bunch of laws on the books about these anti-touting laws, about things that this gal is doing. But no, the new rules that have been proposed that I think are going to be implemented will be limited. You won't be able to advertise for this. You won't be able to go put ads on the marketplace to go find new people. Like, I can't go advertise for investors to then give them to AJ, for example. They already have to be in my world. Like, I have to think of it as like I have to have a pre-existing relationship with the investor to begin with. And if I already have a relationship with them, they're my client, I know them really well, and then I make an introduction to AJ. And I say, look, AJ is really great. I can have a little bit of involvement in the deal. I can actually be on the phone call with AJ. I can go through AJ's, business plan with my client or with my person. I can be somewhat involved, a lot more involved than I can now when I find a thing. Then I can make that introduction to AJ because I have an advertisement. Like, I know this person already, right? And they're accredited. That's another limitation they're going to have. As long as they're accredited investors, and so I already have a relationship, then I can make the introduction to AJ. I've got to disclose it. It's got to be in writing. Everything's got to be disclosed. But there's going to be a mechanism for me to be able to make an introduction, be actually somewhat involved, not handle funds, not make recommendations, but I can be somewhat involved in a transaction, make an introduction to AJ. And if that person invests with AJ, have a deal cut with AJ where he's going to pay me some commission. Again, just to be clear, this is a proposed thing that happened many, many years ago that I believe, with the new commissioner coming on board, will become law. That one I think will take a little bit longer. It's not going to be like within the next 12 months like the accredited investor one. But I think before this administration is over, that rule will be on the books. We'll go from a proposed rule to a final. And every single, I don't want to say capital raiser, because you guys on the show are not capital raisers. You guys are operators. You guys have real businesses. You guys raise capital for your businesses. That's going to open up a big avenue of potential, investor sources from other people.
So question, is it going to be able to be a thing like a deal broker? So like in my sphere right now, we already do it because between Ashley and I, I'm proficient in underwriting and she knows all the other back end inner workings of deals and stuff. Like, people will come to us and be like, hey, can you vet this deal for us? Like, is this something I should be investing in? Is this a good thing? And at any point in time, I've, across my desk, I know just through my sphere, a dozen different deals going on at any time. Is it something that, like, as a broker, like someone could approach me and be like, hey, can you find me a good deal to invest in? And I will go out and I'll be like, hey, like, there's this deal, this deal, and this deal. This deal might work for you if you're, what's your time frame? What's your risk level? What's your this? And I can vet it for them and then place them and get paid for that. Is that something I'll be able to do?
So first of all, you said you were proficient in underwriting and Ashley was doing everything else. What does Jay do in the whole? I'm not quite clear on what Jay's role in your business is.
We need a pretty
Putting that
face,
aside,
outlooking.
No, one of the key things you cannot be in any of these situations, you cannot be making recommendations. You can't tell somebody this is a good deal or not a good deal, right? You can make the introduction, you can show them the deal, you can show them a deal, you can maybe educate them a little bit. Maybe in your case, hey, let me show you some things, some of the underwriting and things but you cannot ultimately make a recommendation whether this is a good investment or not without that broker deal license. I don't think that's going to change.
Okay, cool. Any other questions, guys?
Let's talk about the housing market.
Yeah, I mean, it's been a while since we last checked in on the single family housing market, so we might as well, right? Check in on it. Interest rates still high, inventories still low. Gen Z, they're still not buying houses. But Case Shiller just came out and the price snuck up a little bit, right, AJ? So there's that. But single family housing, is it still like plodding along like it has been, or have there been any changes?
I think a lot of people are waiting for this collapse that is coming. And the question of is it really going to come or not? Everybody, when I say everybody, I mean, if you go in and read the news, right, and you're looking at what the economists are saying and what a lot of the experts are saying is that the housing market's going to go up and that it's, not going to boom, but it's still going to rise. So we see estimates, from 1% to 4%, depending. A lot of 1.5%, 2% out there. Very few people that I've read and looked up said that they think that it'll be negative. And I think that raises a lot of questions because at the same time, inventory is like to 2007 levels. So we have rising inventory on the market. Homes aren't transacting. And I think what's happening is we just kind of have a stockpile, meaning that homes aren't transacting. They're staying on the market longer, yet we're not getting a, kind of a drop and reduction necessarily in price. And a lot of people are thinking that it has to go down, right? So why is it going up if people aren't buying homes? And why, if inventory is stacking up to really, really high levels, why aren't we getting more of a reduction? And obviously, that's a really good question. And I think the first thing is this is a national average. So when you look at the housing market, it's an average nationwide. There are some markets where housing has dropped. And the spreads can be quite large because you have other markets where housing prices have really gone up. We're not seeing, right, a overall consistent. But overall consistently, they're not dropping. That's the key. So we have markets where housing prices have gone down, but they are localized, right? They are very contained within certain markets. I mean, Texas is a perfect example. The difference in literally city to city in Texas is fairly large. If you look at Austin versus Houston, right? And, just individual submarkets of Dallas even. So it is returning to, or not returning, but it is very isolated where we see housing prices actually going down over the year. Month to month, housing prices are changing. So if you look at a month to month, it is seasonal still. So we have seasonal housing prices where seasonally you'll have housing prices will drop, in 1 month, and then they'll jump up in a spring month, and then they'll be down 2 months. And so you're looking on average, and that's why I think in general people are looking at it, it's kind of stagnant. Now, this is below, a lot of people are estimating it's below inflation. So I think
AJ, sorry, when you say seasonally, do you mean like they're seasonally adjusted, or just that during certain times of the year people
During
tend to
certain
buy
times
more?
of the year,
Yeah.
housing prices drop, and during certain times of the year, they go up.
Because people like to move, in the summer when the kids are out of school and whatever, and nobody wants to move in the middle of you're in Idaho, it's freaking snowing in December, and nobody wants to go look at houses in December.
And school districts too are a big thing. Like you want to move for the new school year.
Exactly. And I think when you look at the housing market, the first thing you have to look at is the owners. And so what we want to look at is, if you're driving the overall housing prices down, right? As in, you're a lot of new inventory, but you're also then restructuring. Sellers, meaning sellers have to sell. There's motive to sell lower. And you have lots of inventory going on the market nationwide. So even though inventory's gone up, people are still waiting, and they're not really reducing the house a lot. That's not really happening, and are adjusting it. So let me pull this up, and so we can kind of look. What I did is I took a few numbers here to show, when you look at the owning of the housing market's in really good shape from a standpoint of, if you own a home, most homeowners in the United States are sitting fairly well. Let me make sure here. So can you guys see that?
Yeah, describe what you're showing, AJ.
Right. So what we have is, it says homeowners, and I brought this up because I wanted to look at it, because I saw a title that was, homeowners are losing equity and equity's dropping. And a homeowner in the third quarter of 2024, right? The title is Homeowners Equity Fell. Now, that is true. Homeowners equity fell in the third quarter of 2024. But if you're looking at this chart, you can see the change in homeowners equity since, 2013, obviously, but just since 2019 and 20, it has been astronomical in the amount of equity that has been built into homes. Now, if you look at the overall housing insecurity, meaning renters behind payment and your homeowners that are behind their mortgage payments and lease payments, we're actually still really low. So we don't see.
But isn't that just because no one's moving? Like, I guess the thing is that someone got a mortgage in 2021 or 2020 or 2019, and they don't want to move because they don't want to give that mortgage, and they don't want to refi because the new mortgage is higher. So their house price goes up, their mortgage stays the same. And when traditionally they would sell that house, move into a new one, they would re-lever up, right? They would get more of a mortgage, and that equity would go, and that house would go down. Now no one's doing that. So the equity is just growing, and no one's moving. And it's not transacting again. There's no refis and there's no new purchases.
Yeah, which once again, though, makes it actually more stable because they're not taking on more debt. And that's why when you look at what they're really looking at is, if you're behind payments, right? Both renters behind their lease payments, but then also they're looking at homeowners, and that's really down. So if you look at even like the HUD did their renters fearful of eviction, that's down, and homeowners eviction or fearful, of foreclosure. These are really, really low indicators. And when you start to look at the actual owners of the homes, are they worried about losing their home? Are they going to get kicked out? Are they worried about being able to refinance? All of those different types of things. That's where we're just not seeing a lot of fear. Now, this is all being driven on, right? Housing is a perfect example of supply demand. And that's why we see, obviously localized, but even with supply and demand, you can't underestimate the impact here of interest rates. And this is honestly, the housing market is a story where it's being stabilized because it is so short on inventory. And yet the interest rates make it unaffordable for new buyers to purchase, but it's happened so quickly that homeowners that have mortgages, they're not selling. And so it's not only creating a stagnant market as far as trades go, but the cost to build a home skyrocketed. So replacement value alone is high. In fact, there's very few times that replacement value was over the actual cost, or buying a home was under the replacement value.
Well, not only that, the only houses that are getting built are like starting prices are upper middle class, right? Like there's no lower middle class houses being, if you look, like Gen Z home ownerships has not increased at all over the last 4 years. It just stays the same. And they're supposed to be the generation that's stepping in and shifting the tide and buying all the new houses, and they can't afford the houses because none of these houses that are being built are in their price range.
And so when you look at this, and this charts, I took this off of Fred, and basically all I'm doing is trying to illustrate here an example of the cost of construction compared to the average home price. So after 2008, right, the average home price dropped below the cost of construction, and then that flipped. But we've had a huge run up on the cost to build, and this cost of construction shot so far up due to inflation and with demand that it really is also there's a floor because you can only put inventory out. So meaning to affect that supply demand number, it's not like you can go flood the market with cheap houses. And even if you wanted to do that, well, now we can get in and talk more about the effect of interest rates and those people buying. As the housing, if we're saying right now, you think interest rates are going down or up, well, interest rates have been softening. Now, do we think they're actually just going to drop? Anything else? No, but what you look at is the buyer pool. So once again, supply. How many houses are in the market? You can't replace a house for cheap, and nobody's selling. So it's a very tight market. We have underbuilt in the United States to the tune of over 5 million home shortfall. Tied to that, interest rates have locked people out. But if we're seeing interest rates soften, right, the amount of buyers that can buy at different interest levels, that's what affects that demand lever. As interest rates go down, the increase of potential buyers is astronomical. I mean, right, it is, there's so many people that can start to buy every time you go down, let's say from 6 to 5. So 6% interest to 5 to 4. A 6% to a 4% drop in interest rates opens up the amount of buyers in a housing market that's already tight massively.
But AJ, does the reason why it goes down matter? Because if interest rates go down because, I don't know, the Fed's lowering the rates, and so naturally the 10-year is going down and everything's kind of a smooth, that's one thing. But what if the interest going down because Jay has predicted a catastrophic, just the end of the world? I know that's not what he's saying. I know. You move, yeah, but I mean, if literally if there's a massive panic,
but Jay's predictions already happened, and housing prices are going up.
Yeah, but no, I'm talking about where you remember something again 2000, where the stock market's dropping 1,000, 2,000 points a day.
Housing prices didn't go down.
The Fed comes in and says, "Look, we got to drop interest rates from." Screw this. We're going
to housing might save people too, right? Like think about it. Like if we have all this equity in our houses, and all of a sudden interest rates drop and people need money, like you have a bunch of equity. All you have to do is sell your house, buy a new one, and you're take all that equity out, and it might actually save some of these people, right? Like could that be it used to be people use their houses as these ATMs, but they can't right now because the interest rates are so high. Like if the rates drop.
But my point is that if interest rates are dropping because we have a huge economic problem, and let's just assume it goes so bad, interest rates go down to zero from a Fed perspective, and so your 10-year note your mortgage goes from 7 down to 3 again. But we're in a massive recession. People are getting laid off. I mean, does that really mean you have more buyers available?
Refi your house then. That's what I'm saying.
Yeah, but if interest rates fall, you open it up to millions of buyers. So, like, in the worst financial
They've all
condition,
lost their jobs.
yeah, but that's what I'm saying. It's not a 2% drop. Unemployment went to, what was it, 7% in the great financial crisis. If you go from interest rates at 7 and they drop it to 3, you're opening up to like 15, 20 million people, right? And 2, guess who loses their jobs? It is not actually the credit worthy that are usually the first to lose their jobs. So it's not an apples to apples thing. And that's, I think, why in recessions are actually not tied to housing drops. And we've seen that where it's 2008 was a housing crisis that caused a recession or credit crisis, right? But outside that, lots of times it's done the opposite. It's actually fueled housing prices because of the mechanisms, right, that they're using. People that are losing their jobs, lots of times in recession, aren't the ones that we're going to be buying anyways.
But banks, lenders tend to tighten up a little bit during financial issues, right? Like a bank is going to be really hatching down into, okay, let's make sure you got the income. Let's make sure you got the debts under control. Like they're not like in good times. It's like, oh yeah, we'll give it to anybody. But in recessions, they definitely tighten the belt, right?
Yes, absolutely. And I think if we had supply, that would be a concern. The problem is right now the supply is so low. We're a decade behind. And I think that's what creates that even with tightening, which theoretically, like, I'm surprised. I'm shocked the level of tightening that we've gone through, and we have not seen a softer housing market. Like, who would have ever thought that we could have gone from 3 to 8% interest and the housing market would have gone up?
Yeah. And
like, that's wild.
A personal anecdote. I mean, I'm actually making offers right now on single family homes, and sellers are still, they're not like, oh my God, I got to really drop. It's similar to commercial where like there's that disconnect between like buyers and sellers and where's the cap rate discovery. Like even in the single family market, even though interest rates have gone up, like sellers are like, oh, well, I don't care about that. I still think my house is worth this. And I'm like, okay, but it's, you start doing the math and what the interest rate is and everything. And so sellers are still a little delusional on the single family side as well.
Are they really delusional, or do they just recognize that that's what they need for it to be worth it for them? Because keep in mind, my house, I might think it's worth $1 million, and somebody else thinks it's worth 800,000. If I have,
it's really worth 250. It's worth 250.
I wish. If I have to go move into another house that's worth 800 or $1 million, and I currently have a 3% mortgage, and I'm going to have to replace my current house with another house that has a 7% mortgage. I mean, that it doesn't matter if I think it's worth a little more or a little less.
Yeah, if you switch jobs, it might be worth driving that extra 12 minutes, instead of getting a house that's closer.
And housing affordability, to what Jay's talking about, has actually gone up. So like to Jay, housing today is more affordable than it is not. So it's a weird thing that people lose their minds about when you say it, because to some people, meaning that Jay, the homeowner, it's more affordable today than it has ever been. But to somebody that doesn't have a home, that wants to buy a home, it's more unaffordable than it's ever been.
And here's the interesting thing. We talk about the supply problem. Historically, the supply problem is that we don't build enough houses. These days, the supply problem is, as AJ was saying earlier, the replacement value of houses, the cost to build a new home is more expensive than buying an existing home. And so we have, despite the fact that there is such a tight real estate market right now, new home construction or builder confidence of new homes is in the toilet. Builders are having trouble selling their properties, their new homes, because those homes are priced above existing inventory because it costs so much to build. And so it's not that we don't have enough supply. The supply is out there. The problem is the supply that's out there, the supply that's empty, is new construction that's too expensive.
And one of the reasons why it's so expensive is because it doesn't make financial sense for them to build smaller houses, smaller square footage, because of to be honest with you, all the regulatory compliance and stuff. It doesn't make sense for them to build a 1,200 square foot 2-bedroom. They've got to go bigger because the marginal cost of building a larger house isn't that much, but they can get a higher price.
empty space is free.
Yeah. And so that's the challenge too. It's like, you're trying to build affordable housing, but the cost is just to build that with, look, I'm in California. Like I've got to start doing I've got to build homes that are environmentally friendly. It's like that just costs more money. And if I just build my usual 1,500 square foot 2-bedroom house, it just costs so much people can't afford it. So they have to go higher. They've got to add another bedroom. They got to add, which the marginal cost of adding another bedroom, another 100 square feet or 200 square feet, or another bathroom is cheaper. But then you're at a higher price point.
Well, people act like there's a disconnect between new houses and existing inventory, but there isn't. Like we used to do it way back in the day with single family flips. Like if you put a new product, you always check out what the new construction is pricing at, and you could say, okay, someone who has this option for a new construction, we got to stay X percent below that, and we're going to price that if we're going to maximize it out, and it naturally drags everything else up along with it. So if the price of building goes up, it is going to bring up the cost of the existing inventory as well.
I'm trying to show this to Jay's point here. There you go. So Jay, like what Jay was talking about right now, as you guys can see, that you would think that building, like they'd be putting more inventory onto the market, but they're not. It came down and it's fairly stagnant, even though prices have remained high.
AJ, what are we looking at? AJ, what are we looking at?
Yeah, so we have single family starts and multifamily starts. And I think why this is important is multifamily starts are down and single family starts are down, and they've just flattened out. Like we're not getting any more housing come on, because to once again Jay's point, right, that doesn't make financial sense. But this also leads then to another issue where rent. So if you're not putting new units out, obviously for you guys, this is a good thing, but rent's going to remain high because you have low inventory and you're not getting home buyers. So you're getting more renters as time goes on, less inventory, and the cost of housing isn't coming down. So if you're going to build a new house at today's carrying cost and today's interest rate, what do you got to charge to cover that mortgage? So anything you put out today, so if you are a real estate investor, your holding cost of that asset is so much higher than it was, 3 years ago. And building costs haven't come down. So your coverage to cover that asset is way higher. So anything coming out, adding to supply, isn't reducing rents because they still have to pay, right? And so materials are up, but the cost of debt is up so much that new inventory coming out, that's not making rents go down. They can't.
In some markets, I mean, you brought up the point earlier. I mean, I'm going to reiterate this. This is such an important point. Everybody talks about the real estate market, the housing market. There's no such thing as a real estate market. Everything is so localized. Like right now, I know for a fact, you mentioned Austin, Texas. I know for a fact that in Austin, Texas, there's like hundreds, if not thousands of units that have just come on the market in the last year or so that are driving down prices because there's just a flood of market. You come here to California, it's the opposite. So you can't think of it as these are all averages, but you've got to look at your micro market when you're making these decisions, because there's no such thing as a housing market or a real estate market as a whole.
So looking forward, do we think as investors, either single family or other side of it, do we think this is going to lend to an opportunity for us? Everything like the trends that it's going, or is it still kind of feel like there's a lot of wait and see going on right now?
I think there's opportunity. It's just not even. So like, I mean, for us, I mean, in our world that I'm in, right, we're doing seller financing now. We haven't done seller financing in years. We're doing seller financing on $8+ million assets and portfolio assets because they would rather get a higher price than take a lower one because people can't afford it. So we're getting seller finance deals now. Off-market deals are really common because sellers in the commercial that need to turn it over and stuff, they're starting to realize we're not getting I'm not getting higher prices in my rents, my occupancy. So we're getting opportunities, but it is very divided. So like what Mauricio was talking about, I sold an asset 2 months ago at a 4 cap. And then I bought one at a 8.5 cap that had huge upside in it. And like, that is a huge spread that we didn't used to see. And so depending on the market and the asset type, I think there's opportunities, but it's not overall market opportunity. Like I think in my world, you have to find it and you have to understand value today. And the market's not going to just give it to you.
That's fair. Any other thoughts, Jay?
No, he hit the nail on the head. I mean, the thing everybody wants to know is where are things headed. We just kind of addressed that. And it's like, I don't know. What would it take to change the housing market? Would a recession change the housing market? Would a change in interest rates, significant change in interest rates change the housing market? Would, I mean, what is it that happens? What are we waiting for?
Yeah, I've said it before, but I do think a severe recession, not just a regular recession, but a severe recession would shake things up, because everybody talks about what we talked about today, which is like, hey, why would I sell my house? I got a 3% mortgage. If I sell my house and I want to go buy something else, I'm looking at a 7.5% mortgage. It makes no sense, even if I'm making a killing on my property. One reason you would sell your house is if you got laid off because there was a major recession and you're kind of forced, because nobody's going to give you a line of credit. Nobody's going to be giving you a loan. So you're going to have to sell. Maybe you end up renting, and that frees up the inventory to bring down prices. That's definitely one of the theses that are out there.
Yeah, I still think there's that mental hurdle of 6%. If we can get sub 6% interest rate or mortgage rates, then I think that's going to move the market quite a bit. And we just still have too many people holding on. And I think they'll stop holding once we see that a little bit of movement there.
Well, to Jay's point, though, too, because Jay mentioned what has to happen, how long can this go on? So meaning that how long can inventory stack up? People aren't buying. So how longer will owners? Because there's like this attrition part, right? Like sellers that have to sell whether they want to or not because they have to move or whatnot. But we've just seen inventory stack up as there's just not a lot of buyers. So I also wonder is like not only what has to happen, but how long can inventory just keep stacking up and new buyers aren't coming into the market because they can't afford? Like, can it just sit like this? Like, or is there a time where it really starts to etch away?
If you enter a tough, like we haven't had a tough economic moment since '08, right? I mean, yeah, we had COVID, I guess but COVID's like, oh, there's a reason behind it. There's a whole other narrative. But if you're looking at like a regular '08, maybe not '08, but like a recession type environment, that's where people are like, oh crap, like things go down. We're in a recession. It's tough, and it's not a good time to sell a house in a recession. If you're forced to sell it, you're going to have to take a lower price.
Yeah, but historically, housing prices don't go down during recessions. It's very rare. That 2008 was an anomaly. And yeah, we've seen a couple other recessions where we saw a 0.5% or a 1% drop. But other than 2008 and the Great Depression, the reality is real estate doesn't go down. And it feels like this time should be different because prices are so inflated. But I've been saying for the last several years, I mean, you guys know what I've been saying for the last several years. I think prices are going to be flat while inflation catches up for the next 5-7 years. I don't see it going down.
Yeah, but that was a big turning point. I mean, I remember very clearly pre-2008, everybody was talking about, ever since we've been keeping track, real estate has never gone down. Never, ever, ever has a median price gone down. And that was true. And then lo and behold, 2008, prices went down. So I kind of think that created a new baseline or a new trend. I don't know if I can make that argument anymore that, real estate would never go down again,
I mean, I don't think you could discount the fact that politically we're allergic to recessions now, where the moment there's a sign of a recession, they're going to do everything they can to get us out of there as quickly as possible.
I mean, that's actually an interesting question, and we don't have time to discuss it here, but maybe that's a good topic for a future episode. If we see a recession this time around with the current administration talking about not wanting to raise the debt or raise the deficit, would they treat or would they encourage the Fed and do whatever they had to do to kind of push the Fed not to rescue us? I don't know. I mean, it seems crazy.
Rescuing. They'd take out debt. They're all whores. They'd do anything for the vote.
Fed
Oh, they're
will-
dropping
They would
rates.
take
too.
no
$1
doubt,
trillion
no-
a week.
No doubt in my mind that if we had something similar to '08, and I'm not saying we will, but if we had something like '08, that the Fed would have zero issues in principle to taking us down to zero again if that's what they thought needed to be done.
All that deficit, financial debt talk would be gone in 2 seconds.
There's so many theories too, just saying they're keeping these rates high enough so that they have room to drop it when something happens. So like, I think at least we're going to see that kind of drop, if not full court press.
Yeah, I actually think that that's one of the best arguments to say that we won't see a severe recession. It's because there's so much room to drop. So, I mean, think about right now how, like, what would happen if they dropped rates? Talk about fuel on a fire. I think that's the best argument. The moment we have a real recession, when we're talking recession, I guess what we mean is Main Street, not like what Jay was talking about earlier, how it's just a timing thing. Like we're talking about like real people going bankrupt, like Main Street recession. I mean, they would drop interest rates and they have so far to go down. That's like gas on a fire.
And here's the other thing to keep in mind that we often forget. When we look at these really low interest rate loans, the people that got these loans in 2019, 20, 21, heading into 2022, super low interest rate loans amortize quickly. They build equity quickly. And so these properties are gaining equity a lot faster than most homeowners historically have. So if we do see a recession, a lot of these houses, even if they've only been owned for 3, 4, 5, 6 years, which is a relatively short amount of time, are going to have enough equity that they can refinance, or if they don't refinance, they can sell the house without being in a situation where they have to fire sale. So we're likely to see a lot fewer foreclosures simply because more houses have equity in them because they were acquired at these really low interest rates that amortize quickly.
Well, and then when they sell and then rebuy, they could keep more money out, right? Like their LTV is probably 50, 45, sub 50%, and then they can refi at 70. So they could take some of that cash out and use it to however we want. Our personal savings rate is going to skyrocket.
And incomes are up. Like, and that's where this dichotomy it's kind of sucky, because if you don't own a home, it's really bad. But if you bought a home 5 years ago, it's better than it's been like forever for you.
For sure. All right. To be continued. We'll update again probably in a couple months. Hopefully everything's still rosy and we didn't, April 4th, everything didn't hit the fan and we're all out of our houses. We ready for a top 10, Mauricio?
I gotta go. Actually, I forgot to tell you guys. I gotta go. I got something's going. I think my dog needs to be relieved. I don't know what's going on, but
Whoa! Your dog needs to be relieved.
Go relieve your dog there, Mauricio. No, it was pretty funny last week when you just left. That was pre-planned, though. He had to go, so I
don't blow it. Like, come on, that was
it was funny in the moment, but you actually love my top 10s. I know you do. So one of these things, I've mentioned numerous times about with Canada, is the cost of alcohol going on. And people are concerned, especially in the northern states, about alcohol and how that's going to affect it. And so I thought I'd look up, like, okay, which states are more alcohol? And I found out there's actually a huge difference state to state in the cost of alcohol. And I had no idea that. So I found a stat just where it tracks the cases of Bud Light and Miller Lite. So like the most purchased cases of beer.
You mean piss water?
Basically, but it's the easiest to track with the largest subset, and what the cost of those cases of beer is. And I was shocked on how low it is in some states. Me being in Pennsylvania, spoiler alert, not low. So I thought I would go with I'm going to go with the top 5 lowest prices of a case of 24 beers. And then I'm going to go through our states too. And I'm going to have you guys guess, because you don't strike me as Bud Light or Miller Lite drinkers, so you would have no idea. So I'm going to have that. I want you guys to guess and show your ignorance. So
do you have to pay me to drink that stuff?
So the cheapest state in the U.S. for a case of beer is Illinois. $16.43. You can get 24 beers for $16.43. Next cheapest, South Carolina, $16.54. Then New York State. I actually knew New York State was cheap because I went to college in New York State, and you can go to the gas station, any gas station, buy a case of beer.
You went to college?
$16.72. Yeah, it was great.
Wow, who would have thought?
They closed at midnight though, so we had my house senior year was 2 blocks from a gas station, so it was great because you could throw a party and you didn't have to buy all the beer up front. You could just buy like half of what you thought you needed, and then based on how many people showed up, you just sent the rookies or the freshmen to go and get more beer. So it was great.
Hey Mauricio, 3 guesses at what his major was.
Hockey.
Yes.
Hat. Stylistic.
I guess I should advertise that more, eh, Jay? If he doesn't even know what my major was in university.
And relieving dogs.
Communication.
Relieving dogs. That was my major. Physics. I was a major in physics. I know I don't look at much. Anyway, Kansas, Rhode Island, both around 17.30. Now, Florida, Jay, what do you think a case of beer costs in Florida?
I'm gonna say twice, 18 eggs, $22.85.
Florida, $18.59.
Damn,
Mauricio,
my egg prices
California.
were off. I was right about my calculation. but the egg
California
prices were-
probably has some ridiculous tax on. I'm going to go over 20.
Nope. Actually, California sneaks in under 20, $19.30. AJ.
Do you know what beer is?
Yeah.
I've heard of that.
What do you think?
25.
You're right on. $20.26. And
Wait, what?
Pennsylvania is the 7th highest state at a case of beer is $23.21. I always thought like that $1 a beer was like as low as you got because
What's
that's
the highest? So who's the highest?
So the highest is Alaska, obviously.
Well, that makes sense. What's the next highest?
They're at $33 for a case
Hawaii.
of beer.
I got it, but like the regular folks.
So actually, Wyoming is $28. Which is even higher than Hawaii is still only $24. So I pay as much for a case of beer basically as Hawaii. Hawaii is $24.17, which is ridiculous. I always thought that if I was going to move somewhere, it was going to be based on state income tax. But now that I'm seeing this, that basically like I $8 for every case of beer I'm spending more here, like I might have to reconsider what my conditions are for moving to a different state.
I've got a question for you guys. How much do you think this costs?
Is
A
that
bottle?
you got
Is that the
bottle?
water?
I know.
Bottle of clear rum.
I actually know. I know this because you bought. I actually saw it at the 99-cent store the other day. So it's got to be probably around 99 cents.
$22. $22 if you buy it off the website clear.com, K-O-Y-R.
Jay, I'm going to be in Florida next week. Maybe you can buy me a bottle of Clear.
Mauricio, if you come visit me for Cigar Fest, I will send you home with a bottle.
Yeah, that'd be great. Let's do that. I'm looking forward to this tasteless, caloриeless, odorless, enjoyless drink. It sounds like amazing.
Hey, if it gets you there, who cares? Eh? Anyway, Jay, you got any? I don't see any written down here. You got any of your little shticks going on today?
$50 million, but you got to go hairless the rest of your life.
I mean, dude,
not a hair
brainer.
on your body.
No brainer.
Like,
I'm
no
in.
beard too.
No beard, no hair. All hair
I'm in.
gone.
50 million? I'm in. It's not even close. I mean, I'll do it for.
You got nice hair though,
$50.
Mauricio. You got a great head of hair on you. I feel like that's like you take that away, like you're just a regular guy.
It's like I feel like my spike's going out of control. I think next time I'm gonna really buzz it a little bit further.
And like I got a pretty good hairline considering my lineage and my dad's side of the family. It's got a little.
I've actually thought about it. So I would definitely for 50 mil, dude. That's like $4 million a year guaranteed.
Yeah, I have to be careful with my numbers. I gear most of these towards AJ.
Especially like chest hair. I don't know, like AJ, can we give up our chest hair? Is that like
My God, I shave mine.
Yeah, I shave mine for the
Kramer.
show,
It's
just
grow
so
back
that
thicker,
you
you
know,
know that.
I can. Otherwise, it would be out of control. I don't want to undermine AJ's hair. So I
AJ,
shave
50
mine.
million, no hair.
How much?
50.
50 million. Yeah, I'm in. I would do it.
I'm not asking you, Mauricio.
Oh.
You're a whore. You'll do it for $1.25 and a ham sandwich.
Oh no, beer.
It would take Mauricio a night of sushi.
I think it'd
Let's
take
be
more.
honest.
See, I see. I knew AJ that would be a good number. How about you?
You give me $1 million, I'm in.
I know.
Here's the distinguishing factor. It's a yes or no, and it's my yes or no. Eyebrows.
Yeah, they're gone.
Oh, wait.
Hair.
Eyebrows are gone?
All
Yeah.
hair,
All hair.
eyelashes, all of it.
What,
So
what-
I'd have to paint my eyebrushes on? Ooh, that one, I didn't think of that one. Okay.
all hair.
All hair.
And it's a tougher decision for me and AJ too, because you guys are already gray. Like I'm just starting to get gray. And like it's, you guys are already gray. Like, just get rid of it.
You know, there are people that actually have this medical condition that have to do this without getting compensated at all. So don't be greedy.
There's also people with no leg. It doesn't mean that like we can't have a hypothetical of cut off your leg. Like,
Okay. 20 million lose your left leg at the knee.
no, there's no amount of money there to just lose a leg. I can't do that.
Percentage
All
are
right.
probably
Okay,
pretty
let's
good
do the
these days.
math. 20 million is like, I don't know, $1.5 million a year in income. I don't know about you guys. I'm retiring on $1.5 million.
What?
Annualized, like now I gotta pay taxes on it, but like $1 million net in my pocket without having to work, that seems pretty attractive to me. I'll go on my ranch and raise my donkeys and goats.
You're a ranch guy, huh?
Yeah.
Head out to Idaho. All right, let's wrap this up. Mauricio, I guess you better get first because this is your last plug for a couple weeks. What do you
Dude,
got?
I'm going to plug my elite syndicator program. If you want to if you're a capital raiser, if you're raising money, you're an operator and you want to do it compliantly, if you're worried about not knowing what you don't know and you want to know exactly what you don't know, just go to Coaching with Mauricio. I'm going to change it to Mentoring with Mauricio. It's really a mentoring program, but go to coachingwithmauricio.com and I'll reach out to you and see if it's a fit. But yeah, if you're raising money and you don't want to go to jail.
So Mauricio, I've noticed you have got some coaching clients from the podcast. How did that one last guy work out? Did you email him back? The at gmail.com? Did you?
That was hilarious. I got some guy reach out. I don't know if he was on the podcast, but his name was no, it was like, I forget what it was, but the name even was, the first and last name was funny. And then the email was, the email I think was at gmail.com. But his first name and last name was pretty funny too. I didn't realize that till later, but yeah.
Jay, what do you got for us?
I'm going to plug my Facebook. Follow me, J Scott Investor on Facebook. The last 2 days, I've just decided to be a troll and post obnoxious stuff about tariffs. And I posted something yesterday, got hundreds of comments, like just people arguing and fighting, and it was awesome.
Awesome. AJ, what do you got?
Check out YouTube. So yeah, go check out my YouTube.
Just the website, youtube.com?
YouTube, it's great. They've got they got like previews on it. They've got great content. AJ Osborne on YouTube. Go check it out.
AJ Osborne. Check him out on YouTube. I'm going to go back to plugging my wife. I plugged Conference Connect there for a little bit, but plug my wife at Badass Investor. Check her out on YouTube, Instagram. Tell her what you like, what you don't
That's
like,
good.
what
Dude,
you want to
that's
see
good
more
to
of.
hear. You have not been plugging your wife in a while, so that's good to know that you're plugging her again. That's good.
Yeah, I'm back to it, a regular plugging. So
Nice.
it's going to be
Nice.
great. Mauricio, I'd like to say we're going to miss you, but I think we have a great guest coming in. I don't want to spoil it.
Yeah,
but,
we have a good show next week.
We're going to have a great one. So tune into that. So for everyone except Mauricio, I will see you next Thursday.
See you guys.